Welcome to the Deep Dive. Today, we are not just looking at quarterly earnings, no. We are analyzing a battlefield.
That's the only way to put it.
Two retail titans, Walmart and Target, just dropped their Q3 reports. And the data, it is far more consequential than usual. This is a high-stakes war for market dominance.
It really is. And the results define everything, not just the affordability crisis, that's gripping the consumer, but the entire digital future of commerce. We're here to process the shockwaves.
Absolutely.
And our mission today is critical. It's urgent. We've synthesized the raw intelligence, the earnings calls, the financial filings, all the executive commentary to determine the trajectory and, frankly, the fate of these two giants.
And the picture is stark.
Oh, it is. Walmart just unleashed an absolute game changer. A data point so massive, it literally shifts the foundation of the industry. Meanwhile, Target is admitting they're in a crisis.
A full-blown crisis.
And they're attempting this desperate, sudden counterpunch, a massive capital expenditure. So we have to answer the core question. Is Target's internal struggle terminal? Or can their, $5 billion gamble and this new AI strategy actually reverse the momentum before Walmart becomes completely untouchable?
And you just have to look at the scoreboard right away. Walmart didn't just win Q3. They detonated what we are calling their secret weapon.
Yeah.
A mind-boggling, just jaw-dropping digital growth number.
It's incredible.
It proves they are no longer just the king of physical retail. They are a genuine digital powerhouse, and they're gaining market share while everyone else is struggling.
And on the other side,
meanwhile, Target is sounding all the alarm bells. Their leadership is openly, publicly admitting they are far from satisfied with their results, and their high-margin business, the engine that makes Target is bleeding out.
Okay, let's unpack this.
The brutal details start now.
All right, let's start with that seismic event.
We have to.
Yeah.
We have to focus on the single data point that just defines Walmart's dominance this quarter. Global e-commerce sales surged an insane 27% year-over-year in Q3.
27%.
And if you isolate just the U.S. segment, that growth accelerated even further to 28%. 28%. We need to understand what that number actually represents, because this isn't just a high number.
No, it's proof.
It's proof that Walmart has completed its transformation. They're a technology company that just happens to use its stores as physical infrastructure.
It is truly astonishing, and the context here is everything. A lot of retailers had that digital bump during the pandemic, right?
Right, and it's since faded.
Right, it's all come back to earth.
Exactly.
But the source material emphasizes this surge is structural. This marks the 7th consecutive quarter of e-commerce growth above 20%.
Wow, 7 quarters.
This level of sustained performance, it signals that the business model is working precisely as they intended. Walmart has mastered the omni-channel model. They've blurred the lines between the digital checkout and the physical pickup counter.
But I have to challenge this, just slightly. We know consumers are trading down because of inflation. Walmart specifically said food prices are still about 25% higher than pre-COVID. So, is this 27% growth purely organic demand driven by convenience? Or is a huge chunk of it just market share theft from mid-tier retailers who can't compete on value?
That's a crucial distinction, and the answer is probably a bit of both. But the mechanics of it prove it primarily structural strength.
Okay.
If it were just market share theft, we'd expect that growth to be largely in their essential categories, right? Like grocery.
Makes sense.
But the primary driver of this explosive growth, and they detailed this in their commentary, is store-fulfilled pickup and delivery. This means the investment they poured into logistics is paying off big time. They are successfully weaponizing their vast network of over 4,700 physical stores.
They're turning them into little distribution centers.
Incredibly efficient, localized distribution centers, yes.
Which is the exact strategy Target pioneered with drive-up and order pickup. But Walmart is just applying it at this colossal industry-defining scale.
It's the scale, exactly. They have proximity to 90% of the U.S. population within just 10 miles.
90%.
That physical advantage, when you couple it with a 28% digital acceleration, is a virtually insurmountable competitive firewall.
It really is.
And the financial brilliance of this digital momentum goes way beyond just moving boxes faster. It's also accelerating their high-margin revenue streams.
Here we go.
Yeah. While the marketplace expansion is strong, the true long-term value lies in their advertising business. Think about this. Their global advertising business, which now includes Viz.io, grew by a staggering 53%.
53%.
And Walmart Connect in the U.S. alone That segment jumped by 33%.
Okay, let's unpack this for a second. For you listening, why is this advertising growth such a game changer, maybe even more so than the 28% sales growth?
Because it fundamentally changes Walmart's entire profitability profile. I mean, retail is a razor-thin margin business. We all know this, especially in groceries.
Paper thin.
Right. But advertising revenue, what they call retail media networks, is high-margin, sticky revenue. Walmart is leveraging the massive amounts of data generated by their 28% digital growth and all their physical store traffic to offer highly targeted advertising.
So the brands, the companies that sell products at Walmart, are paying a premium to reach those shoppers at the exact moment they're making a purchase decision, both online and in the store.
Precisely. And the Vizio integration makes this incredibly powerful. Vizio gives Walmart customer data from smart TVs about what people are watching.
Oh, wow.
So when you marry that entertainment data with transactional data, what you actually buy in the store and online Walmart can offer advertisers this unparalleled view of the consumer journey.
So it shifts them from just being a low-cost volume seller to a sophisticated, profitable, high data leverage digital platform.
It's a direct rival to Amazon's strategic playbook.
Yes, that is the definition of a tectonic shift.
Yeah.
You're using the low-margin grocery business to draw people in, and then you fuel a high-margin digital advertising engine on the back of it.
And none of that growth is sustainable without the underlying operational efficiency.
Right.
That 28% T-commerce acceleration puts immense stress on the supply chain, which brings us to the second critical element of their secret weapon. Automation.
Yes.
Absolutely. The massive sales numbers only matter if your cost to serve doesn't just eat all of your margin. And Walmart has been investing heavily in automation for years, and now, right now, we are seeing the results of those strategic capital expenditures.
And the numbers are just as crazy.
Their next-generation fulfillment centers are now reported to be twice as productive as the older facilities. This efficiency is driven by an aggressive deployment of robotics, high-density storage systems, and advanced inventory tracking sensors. It minimizes human touch points and just maximizes speed.
Twice as productive. I mean, that figure is unbelievable given their existing scale. It means they can process a far higher volume of orders with less labor cost, which just reinforces their low-price leadership.
And the integration of this automation across the entire network is staggering. Over 60% of their U.S. stores now get their freight from these highly automated distribution centers.
16%.
Furthermore, over 50% of their e-commerce fulfillment volume is now automated. This isn't some pilot program.
No, this is standard operating procedure.
Exactly. They have fundamentally automated the complex logistics of moving goods from the supplier to the last mile, creating this efficiency moat that very few competitors, including Target, can even hope to scale to.
And the output of all this digital and operational dominance is just crystal clear on the financial scoreboard. Total Q3 revenue hit $179.5 billion,
An enormous number.
a robust 5.8% year-over-year increase. Their Walmart U.S. comparable sales, excluding fuel, were up a healthy 4.5%. And this success gave them the confidence, the internal conviction, to raise their full-year guidance across the board.
Which is always a huge sign.
It's the loudest signal possible. Net sales now projected to increase up to 5.1% and adjusted operating income up to 5.5%. When a company raises guidance like that, it tells you they believe they have the competitive advantage locked down and are, in fact, crushing the competition.
And that rising guidance is a direct reflection of two things. Confidence that consumers are gravitating toward value, so market share capture, and the high profitability of those digital channels, which is driven by advertising and automation.
So the 27% isn't just about selling more stuff.
Not at all. It's about fundamentally changing the game by embedding efficiency and these high-margin revenue streams right into the core of their low-price business model.
And here's where it gets really interesting. Walmart has successfully transitioned from being the physical price leader to being the indisputable digital cost leader. They have secured the high ground. Now, let's pivot sharply to the rival across the fence, where the mood is far from celebratory.
The contrast is just dramatic. If Walmart's report was a digital explosion, Target's report was a loud warning bell.
A 5-alarm fire, maybe?
Maybe, yeah. Target's Q3 results highlight exactly where they are struggling most under both macroeconomic pressure and the intense competition we just detailed. The headline metric is damning. Q3 comparable sales were down 2.7%.
That's a brutal number in retail. And this wasn't an isolated incident, which, makes it even more worrying for investors and stakeholders.
Right. It followed a 1.9% comp sales decline in the prior quarter.
So you're reinforcing this deeply concerning negative trend for a company that relies on consistent growth to justify its premium valuation.
And that top-line softness translated directly into financial pain. Total revenues fell 1.5% year over year to $25.27 billion. When sales shrink, pressure is placed absolutely everywhere. Their adjusted EPS, that's earnings per share, declined 4% year over year to $1.78.
So declining sales, plus you've got margin pressure from markdowns, means the whole financial focus shifts very quickly from growth to just operational survival.
That's right.
But the real core of Target's crisis lies in identifying where the bleeding is coming from. Target's brand identity, its profitability, it's all built on those high-margin discretionary categories.
Fun stuff.
The stylish apparel, the trendy home decor, the things you don't need, but you go to Target specifically to want. And that's precisely where consumers are pulling back because of inflation.
The earnings call confirmed it. Persistent and debilitating softness in those high-margin discretionary categories. Apparel comps, for example, were down 5%.
5%, ouch.
And home goods saw similar struggles. This confirms that the consumer is choiceful, as Target management termed it.
Which is?
It means shoppers are prioritizing essentials, groceries, health, and beauty, and they're either delaying or just eliminating those high-margin fun purchases.
Choiceful is just corporate speak for consumers looking at a stylish threshold throw pillow or a Cat and Jack sweater and saying, you know what, I can wait. And this isn't just about declining sales. It's about volatility in those sales. The sources show shoppers are actively waiting for deals. They're waiting for promotions.
Right. They see these pronounced dips in sales the week before and the week after their big Target Circle Week promotional events.
Consumers are becoming incredibly resourceful, which is just death for retailers who rely on full-price, high-margin sales.
Now, to be comprehensive, we have to acknowledge the few bright spots.
Okay, there were some?
Target's essential categories, like food and beverage, continued to deliver positive comp growth. That aligns with the general consumer shift towards essentials. And they also found a niche win in a newly focused hardlines category they called Fun 101.
Fun 101.
Yeah, it covers things like toys, video games, entertainment. Toys saw nearly 10% comp growth, and music and video games posted double-digit increases, all driven by unique, on-trend assortments.
But those little niche wins were just nowhere near enough to offset the persistent decline in the crucial high-margin categories that historically define Target's financial muscle.
Not even close.
And that brings us to the most painful, most alarming comparison point. The digital chasm. We just spent all this time detailing Walmart's 28% U.S. e-commerce acceleration.
And Target's digital comparable sales grew a mere 2.4%.
2.4% versus 28%.
That gap just highlights the sheer scale of the competitive challenge. Now, Target has a good narrative around their same-day services, which grew more than 35%, fueled by their Target Circle 360 loyalty members.
Which is good.
It is good, but the overall digital growth rate is barely registering on the national scale compared to the blistering pace set by Walmart. It is very hard to call 2.4% growth competitive momentum when your main rival is accelerating at over 10 times that speed.
And this realization, of falling behind, of being unable to keep pace with the efficiency and digital scale of Walmart-led Target management to this profound admission of crisis.
They were blunt about it.
They were. They stated bluntly, they are not satisfied with our current results, and critically, our business has not been performing up to its potential over the last few years. That is management owning the failure.
It is. It's recognizing the need for drastic measures. And those drastic measures included immediate internal restructuring. To gain agility and improve their decision-making velocity, Target actively cut staff.
Yeah.
They eliminated approximately 1,800 roles, which is about 8% of their headquarters footprint.
8% is a lot.
It's a huge number. Now, management emphasized this was primarily about removing complexity and improving speed, allowing them to make faster, bolder decisions, especially in product curation. But cutting 8% of HQ staff is the definition of a dramatic effort aimed at surviving intense competitive pressure. It signals internal urgency.
It's that merchant roundtable evolution they talked about. They want to decentralize decision-making, spend less time in meetings, and more time being creative and responsive to trends.
Especially in apparel and home, where they are currently suffering.
Right. They need to get products designed, ordered, and on the shelves faster than ever before.
That's the strategic goal, yes. To clarify roles, streamline accountability, and empower the teams. But when you couple declining sales, plummeting margins in your key categories, and this vast digital disparity with immediate staff cuts, the message to the market is crystal clear. The patient is sick, and Target knows it.
So what does this all mean? It means Target is bleeding revenue from its most important high-margin categories right when Walmart is accelerating away, leveraging both superior value and this operationalized digital scale. They're now forced into a costly high-risk intervention.
And they know they can't coast.
No. Facing a shrinking top line and immense market pressure, they are mounting a massive strategic counterpunch. This takes the form of a huge capital commitment for the next fiscal year.
A huge one.
Target is ramping up its CapEx, that's capital expenditure, the money they spent on upgrading stores and tech, to approximately $5 billion.
$5 billion, and that's a substantial $1 billion increase from the current year's expected $4 billion. The CFO stressed this increased spending is aimed squarely at achieving sustainable, profitable growth.
So they're not just throwing money at the problem.
No, it reflects this profound acknowledgement that superficial fixes just won't work. They need foundational, comprehensive overhauls, spanning every single aspect of the business.
But the key question we have to ask is about timing and viability. I mean, when Walmart has already secured this massive lead in automation and digital platform revenue, is $5 billion enough to save Target? Or is this effort just too little too late?
And how long does it take for $1 billion in new spending to actually translate into competitive sales growth?
Right.
That's the high-stakes risk here.
Right.
Investments of this magnitude typically have a 2 to 3 year timeline before the full ROI, the return on investment, is even realized.
2 to 3 years is an eternity in retail right now.
It is. Target is essentially betting that they can execute massive change faster than Walmart can continue to grow. Their $5 billion commitment, the largest change in a decade, is focused on 3 strategic pillars, framed as direct attacks on the weaknesses we saw in their Q3 report.
So let's detail these pillars, starting with the heart of Target's identity problem. Pillar 1, reestablishing merchandising authority. This is all about the product mix and the in-store experience.
Correct. Target needs to re-engage that discretionary shopper who is currently holding back their wallet. Management announced they plan the most significant physical floor pad changes in their stores in any year in the past decade.
So what does floor pad changes mean in practice?
Think of it as completely changing the layout and flow of a store, specifically where the merchandise sits and how it's displayed. It's an enormous operational undertaking that disrupts existing routines, but the goal is to transform those struggling high-margin businesses.
So what does this look like for a category like home, which has been so soft?
They are specifically aiming to revamp the entire home business. This means moving away from dated styles, focusing on elevating the quality and the style perception, and reinventing key proprietary brands like Threshold.
So a full refresh.
A full refresh. They believe that by injecting newness and better design, they can reignite that excitement and that urge to splurge that defines the classic Target run.
And they're also investing in baby.
Heavily. They view it as a critical acquisition category for long-term customer loyalty. The bet is if they can capture the new parent, they capture decades of future spending.
Okay, so that's the product. Shifting to the environment itself, the second pillar is their elevated experience, which is basically their physical store defense strategy.
Right. Even with Walmart's digital surge, Target is wisely betting on the fact that the physical shopping experience still drives the vast majority of retail sales.
That's a crucial fact that often gets lost in all the digital hype.
It does. Data shows that nationally, retail sales are still only 19% to 22% online. The store remains the dominant sales driver, it's the brand identity anchor, and it's the hub for digital fulfillment.
And Target is defending that turf with massive investment.
Exactly. They're opening new, larger format stores, which they report are already outperforming initial sales expectations. That's proof that consumers respond to a superior physical environment.
And they aren't just opening new stores, they're overhauling the existing fleet.
Precisely. Intensive remodels of existing stores are planned to ensure every location brings the latest and greatest store experience to drive a reliable sales lift. But what's really interesting is the operational complexity they're tackling.
How so?
They're using learnings from a Chicago pilot model where they designated some stores as brown box shipping specialists.
Okay, what exactly does a brown box shipping specialist store do?
It's a targeted operational improvement. Think about it. The busiest, highest traffic stores are typically burdened with processing vast amounts of digital orders for shipment, the brown box fulfillment.
Right, it clogs up the back room, takes staff away from the floor.
Exactly. So by designating certain less busy stores as specialists in that task, they free up the most critical, high-volume stores to focus purely on serving the in-store guest experience. It minimizes store clutter, maximizes employee availability for in-store service, and improves the overall shopping journey.
Smart. It's all designed to protect the very physical experience that separates Target from pure e-commerce players.
And that brings us to the most aggressive high-tech piece of the puzzle, the third pillar, technology acceleration and the AI counterattack.
This is where Target is trying to leapfrog Walmart's digital infrastructure lead.
This is their high-tech gamble. They're modernizing foundational tech, starting with the basics, inventory forecasting using machine learning. And they've already shown tangible progress here. The on-shelf availability of their top 5,000 items.
This is what, 30% of their unit sales?
30% of their unit sales exactly saw a meaningful 150 basis point improvement in Q3.
Just quickly for clarity, a basis point is 1/100 of 1%. So a 150 basis point improvement means a 1.5% better on-shelf availability. That might sound small, but at the scale of Target, that's millions of dollars in saved, non-lost sales.
Precisely. It's foundational efficiency. It's necessary, but it's not enough to catch Walmart. The true counterattack is the explicit, publicized announcement of an OpenAI partnership focused on generative AI platforms.
They're calling this conversational curation.
Yeah.
This is the sensational part of their strategy. Target is betting that the next wave of shopping won't be scrolling through a website, but talking to an AI. They want to embed the Target shopping experience directly into the Gen AI environment. So what would conversational curation actually look like for someone listening?
Okay, imagine you're using ChatGPT or a similar Gen AI platform. Instead of going to Target's app and searching for 4 different items, detergent, a new sweater, a birthday toy, and ingredients for dinner, you could just prompt the AI.
Like a single sentence.
A single sentence. Hey, plan a themed birthday party for a 5-year-old, make a shopping list for the ingredients, and order me a replacement for the detergent I just finished.
And Target's partnership aims to be the fulfillment engine for that whole conversation.
That's the goal. Target aims to be one of the first retailers on OpenAI platforms to not only handle the sophisticated conversational recommendations, but also facilitate the critical functions. The purchase of multiple items in a single transaction, the inclusion of fresh food, and crucially, the integration of their unique fulfillment options like drive up and pick up.
So they're trying to bypass the established e-commerce infrastructure, that digital chasm, by integrating themselves into the fundamental architecture of the next computing platform.
A true leapfrog attempt.
If we connect this to the bigger picture, Target is trying to spend its way out of trouble, and they are betting their $5 billion on foundational changes to their stores, coupled with a high-risk technological gamble. They need this AI play to be an absolute game changer, just to have a prayer of catching up to the sheer volume and operational efficiency Walmart has already secured.
They're not waiting for the economy to rebound. They are aggressively driving structural change with immense urgency because they recognize that the window to stop Walmart's acceleration is closing, and it's closing rapidly.
All right, let's synthesize these results and deliver the verdict.
Let's do it. The competitive scorecard based on these Q3 metrics. The contrast in growth trajectory is the defining narrative of this quarter.
No question.
Walmart is accelerating. Nearly 30% digital growth, raising its full-year guidance, projecting total confidence. Target, conversely, is shrinking. Nanak is 2.7% comparable sales, dealing with internal restructuring, and narrowing its full-year adjusted EPS guidance to the bottom half of the prior range.
And when we analyze consumer behavior, both companies agree the consumer is under severe duress. Walmart calls it the affordability crisis. Target notes the consumer is choiceful.
But the difference is where the consumer is taking their wallet.
Absolutely. Walmart's deep value proposition and massive scale in essentials are attracting the lion's share of traffic and spend. They are gaining market share even under pressure.
While Target, reliant on those high-margin discretionary buys, suffers immensely when the consumer tightens their belt.
Which is also visible in the investment arms race.
It is. Walmart is reaping the benefits right now. Their robust returns and efficiency gains are the direct result of massive, multi-year investments in automation, logistics, and that dominant digital advertising platform.
They're harvesting. Target is planting.
Oh, a perfect way to put it. Target is in a high-stakes catch-up position. They're committing a vast sum, that $5 billion next year, to overhaul their entire foundation. But it's capital being deployed to fix today's problems rather than build tomorrow's insurmountable advantages.
And the pressure on Target's management is just palpable. They are being held highly accountable for turning this ship around, but they warned explicitly that fixing the top line,
Getting sales growth back to positive.
it won't happen overnight. The market is expecting inconsistency for the foreseeable future, as these $5 billion changes take time to implement and yield results.
Target's only real hope strategically is that when discretionary categories inevitably rebound, and they will eventually, Target's strength in stylish apparel and home goods will provide them with massive upside.
Upside that Walmart, which is less focused on high fashion and trendy items, probably can't capture.
Exactly. But until that economic rebound actually occurs, they face significant volatility and the financial strain of competing with Walmart's price structure.
Now, it's important to give credit where it's due. Target isn't completely devoid of high-growth, high-margin operations. While the core retail operation struggles, their lifeline is their non-merchandise revenue.
A critical point. This includes their internal media business, Roundel, their Target Circle 360 memberships, and their marketplace contributions.
And those non-merchandise sales grew.
Yeah.
What was it?
An impressive 17.7% in Q3. This is high-margin revenue that operates as a critical financial buffer. It helps significantly offset the pressure on the gross margin caused by having to mark down all those struggling core discretionary goods.
It's the platform revenue that helps stabilize the balance sheet while the core store business undergoes its costly transformation.
It is.
So this raises the big, important question. In a world dominated by scale, automation, and digital speed, can Target's $5 billion gamble and this AI counterattack reverse a grisly stock decline and actually catch a competitor who is moving at a blistering 27% growth speed?
The data confirms the battle is far from over, but the current undeniable momentum is firmly on Walmart's side.
So to quickly recap the state of the retail war, Walmart is currently winning the digital battle, using that 27% e-commerce explosion as its primary secret weapon, backed by aggressive supply chain automation and a dominant high-margin advertising platform.
And this dominance has forced Target into an urgent, costly transformation marked by internal staff cuts and a massive $5 billion investment aimed at overhauling its physical stores and trying to leap into the next generation of digital tech.
The ultimate strategic battleground, the one that defines the long term, is that digital frontier.
It is. And Target's radical bet to embed shopping directly into global AI platforms like OpenAI for this conversational curation is a bold, high-risk strategy. It seeks to bypass the existing digital channels that Walmart completely dominates and create an entirely new, friction-free pathway to purchase.
So the final provocative thought for you to consider is this. In this escalating retail war, does placing the shopping experience directly within a cutting-edge generative AI interface, allowing shoppers to literally converse their way to a multi-item, drive up fulfilled order, provide Target with a unique and profound enough technological advantage to disrupt Walmart's immense operational scale and existing 28% digital volume? Or is Walmart's command over efficient fulfillment and its current digital market share simply too vast to overcome by novelty alone?
That decision scale versus technological leapfrog is the question that will define the retail landscape for the next few years, and it's where the real $5 billion gamble lies. Thank you for joining us for the deep dive.